Okay, let's explore accelerated depreciation and net present value. So here's the question. True or false? Accelerated depreciation increases the net present value of a capital investment compared to straight line depreciation. The statement is true. Accelerated depreciation does increase net present value. Let's understand why. All right, first we need to think about depreciation timing. Accelerated methods allocate more depreciation expense to the early years in an asset's life compared to straight line. Okay, in this example, and you see the graph on the right, we've purchased a $100,000 asset. It has a 5-year life. If we were using straight line depreciation, the depreciation would be $20,000 per year, 100,000 divided by 5. But with accelerated depreciation, we'll take more depreciation in the early years. So in this example, 40,000 in the first year, then 24,000, then 14,400, and so forth. Now, there's a concept called the tax shield from depreciation, or the tax shield effect. And you can calculate what that tax shield is. It's depreciation times the tax rate. Why does this work? Because the tax code allows us to record depreciation as a necessary business expense. Since it's a necessary business expense, we pay less in taxes because we get to claim this deduction. Now, with an accelerated method, higher depreciation in early years creates larger tax shields or larger tax deductions sooner, so more cash can be retained in early years when it's worth more. Let me explain that concept. That has to do with the time value of money, right? If we're using net present value, which uses the time value of money, we need to understand that the impact of dollars in the early years has a greater impact on the calculation of net present value than in later years. Okay, so a dollar saved in year 1 is worth more than a dollar saved in year 5, and the graph on the right shows that. Shows that we get a greater benefit from greater cash flow savings in the early years. Now, if we were to go through a numeric example, here we're going to compare an asset cost of $10,000 with a tax rate of 30% using a 10% discount, and you can see that we get a different amount of tax shield, and we have to calculate the present value of it. And we can compare, well, at this point, we're just calculating the present value of the tax shield. Okay, and doing that, we come up with $2,284. That's the total present value of the tax shield. Okay, so there's 3 takeaways. First, accelerated depreciation shifts tax benefits forward in time. That's compared to using a non-accelerated method. The straight line method is the one that comes to mind. 2, earlier cash flows are more valuable because of the time value of money. And then the third takeaway is that the total tax yield is actually identical in terms of dollars, but the timing creates value because of the way the time value of money works, or another way of saying that, the total tax shield is beneficial to us because net present value considers the time value of money.